A happy 2022, everyone, and thank you for joining us today for the Future Fund's 2022 Tesla Outlook. I'm Gary Black, co-founder and managing partner of the Future Fund ETF. With me today is my co-partner, co-founder, co-PM, David Kalis. Today I want to cover four things. One, I want to talk about the December employment numbers, which obviously if the market doesn't really seem to like that much. It's causing some angst. And I also want to just cover the overall macro backdrop, which has wiped out all the nice fourth quarter gains we got from the great delivery numbers on Monday. It seems like it was forever ago. It was Monday. Second, I want to talk about fourth quarter earnings and the full year 2022 earnings outlook. Our estimates are way above consensus. We think that'll correct itself on January 26th, which is when we think fourth quarter earnings will be. It could be the Monday. They reported on Monday as well. And Elon will join the conference call and give us product roadmap, which I think people will take that very positively. Number three, I want to talk about Tesla Catalyst, which again, the Elon roadmap will be some of that. But in 2 years of owning Tesla, I've never seen a more robust set of catalysts as what we have right now. So let me talk about the December employment numbers. And we did attach to the YouTube invite. We're going to try this, see how it goes, a set of 12 charts. A lot of these are macro charts that we look at. Some of those you'll recognize are from James Bullard, St. Louis Fed chair. He's a voting member of the FOMC for 2022. And some of those are from his presentation. And there are others that I wanted to include. So obviously the market didn't like the numbers, surprisingly, but maybe not as surprisingly as you think. Nasdaq's down about 0.8% the last I looked. 10-year Treasuries up to 179, so it's up about 7 basis points. So what happened? December payrolls came in at 199 for the month, which was way below where the consensus was, which is about 440 in terms of new jobs added. And October, November were both revised upward. I think what a lot of people are focused on in the market is the unemployment rate fell to 3.9%. The expectation was 4.1. And for those of you who want to get into the details, that's from a whole different survey. It's the household survey. They ask if people are employed, and they divide by the number seeking work and who are employed, and they subtract that from one, and they come up with the unemployment number. And so that number 3.9 was way below where consensus was. And then the third thing, I think that, I don't want to say to nerve people because it should have been expected, but the hourly wage rate was up 0.6%, which I think consensus was 0.5. So that was a little bit hotter than people thought. So how do you make sense of this? I think Omicron, even though it was in its early stages back in December when the survey was done, and remember, there's two surveys, one of employers and one of households, it is likely a factor. People are staying home. The BLS numbers, which is the numbers that you saw today, unlike ADP, they measure how many people are getting paid, whereas the ADP numbers measure how many people are on the payroll. And so if you're not getting paid, you would count as not worked. And I think that's why part of it, the numbers were low. And I also think with COVID, a lot of people, and I know this just anecdotally from people I know, they don't want to go back to work. They want to be staying at home or they want to be self-employed. So they're trying, selling things over, different online forums, whether it be Instagram or anything else, day trading, who knows, some maybe more impure activities. But I think you got a lot of people who are just saying, I don't want to go back to work. I'm worried about COVID, and I'd rather try doing it on my own. So you've got this market rotation, and if there's unemployment and the hourly wage rate, unemployment is low, the hourly wage rate was higher than people thought it would be. That's causing people to be more negative. It's causing people to say, I don't want to own what we call long duration equities where the cash flows are far out into the future, because we're worried that if the Fed starts raising short-term rates, which are right now at 0, and that's called the federal funds rate, the overnight rate, it could cause long-term rates, which is what drives stock prices. And we look at the 10-year Treasury. We'll talk about that in a minute. It could drive 10-year Treasuries not to 1.8, which is where it is today, but much higher. If the Fed somehow concludes that it's lost control of inflation, even though they believe that it's going to come down this year, then the rates could go much higher than 1.8, go to 2 or 3 or 4. And as I'll show you one of my charts, stock prices and PEs are inversely related to higher interest rates. So once you get up to 3, 4, 5 range, then you really see the curve come down in terms of valuations. So that's kind of the backdrop of what happened today. Let me turn to the charts because I really want to kind of give people a little bit of background about what's been going on. Obviously, with Tesla, we had a great deliveries number, and it's given it all back and then some. And it's because of what I'm going to show you on these charts. So if you look at slide 1, you can see that we've had, this is the change in the 10-year Treasury week to week going back a few years. This is the biggest change in terms of a week, in terms of the basis points, since all the way going back to 2019, so before COVID. So when you add the 7 basis points today, because this chart was done last night, we're up about 27 basis points this week. And you'd have to go back to like November of 19 to get a number bigger than that. So that is, obviously spooking the market. And if you look at what is the Fed up to, so the Fed minutes came out, I guess it was 2 days ago now, and what we know about the Fed is they have a 2% goal for inflation, and you can look at core inflation, which excludes food and energy. You can look at overall inflation, but they try to shoot for a 2% inflation target. And if you look at 2020, it was below 2%, and that's what the Fed has gone to. It's an average 2% target, and what they originally said was we can live with above 2% because as long as it's on average about 2%, we think that's fine. Remember, the Fed has a dual mandate, as they call it. They need full employment, and they want to, keep stable pricing. That's its dual mandate. And so where we're at now is after literally about 6-7 months, because this started March, April, we've got inflation that's still up in the 5 range. If you exclude food and energy, it's kind of in the mid 4s, but it's well above that 2% number. And one of the worries I think the Fed has is the more Omicron persists, the more there's going to be labor shortage. There's more going to be part shortages. You're already hearing about, things in Asia, in China, maybe other countries where they can't get enough workers, and that's causing shortages. So that's the worry, I think, and that's why you've seen a real hawkish turn in the Fed in the last 2 months. I looked today. There's you have a Bloomberg. You can look at the chance of a Fed rate hike in March, which is what people are thinking. Today it's 90%. That number was 20% in November, was 50% in December. So this has really been in the last month or two that everybody's gotten, I want to say comfortable or baked in is probably the better word, that the Fed will raise rates when the QE ends, because remember they were basically tapering QE, and they're now tapering at 30 billion a month, and that'll go to zero come March. The new thinking is come March you'll see the Fed start embarking on interest rate increases. And I think what also threw people the other day is they started talking about QT. QT is quantitative tightening, and that's reducing the balance sheet. So it's the opposite of QE. And while nobody put a number on it, you could see in the minutes that they were talking about. And James Bullard, who talked yesterday, who is a voting member, he's the St. Louis Fed pres. He's very vocal. He's a hawk. His view is that we should probably start reducing the balance sheet at the same time we start raising rates. So I think that kind of threw people a little bit. Okay. So look at slide 3. Slide 3 just goes through this in a little bit more detail. You can see that the balance sheet, which again is either QE or QT, so you're buying assets or you're selling assets, that was at about 4 trillion back pre-COVID. And today, and that's that gold line, and today you're up at about 8 trillion, so it's doubled. And in every other Fed tightening period, and we can say as Fed starts raising rates, you've never seen a balance sheet that is as swollen as it is today at 8 trillion. I think the last tightening move, which back in 16 was about 4.7 or something like that. It wasn't anywhere near what it is today. So I think there is a view that they have to get that number down. Now, there's another person that's spoken the last 2 days. That's Mary Daley. She's the president of San Francisco Fed. She's not a voting member, and she would rank at the bottom more dovish. Her view is that they shouldn't start with QT until interest rates normalize. So you hear that word a lot. What is normal interest rates? Normal is once you get back to kind of what they call a terminal rate of interest rates, and I think most people kind of put that number to between 2 and 2.5%. And again, today we're at 0. So the Fed in their December minutes talked about 3 rate hikes in 2022, 3 more rate hikes in 2023, and then a terminal rate of between 2 and 2.5% before they get done raising rates. Okay, so go to slide 4. And again, dual mandate. One is maximum employment, one is price stability. And I think this is a very handy chart. This looks at the number of unemployed persons per job opening. This is a James Bullard favorite. So he usually includes this in his presentation. And look, this is why if you're the Fed, you're thinking, okay, maybe we need to start raising rates more aggressively and using other tools to tighten, meaning you could do QT as well as raise rates. So if you look at any kind of recession, you have a lot of unemployed people per job opening. 2008, that number came all the way down. We had COVID, that number spiked up again. And now since COVID ended, and COVID hasn't ended obviously, but since the economies have all reopened, at this point, there's not a lot of closure because of Omicron. The number of unemployed persons per job opening is down, pretty much where it was before COVID. And so that's a very important chart that the Fed looks at. And then slide 5 is just the target inflation. I mentioned before, it's a 2% target. This is looking at core inflation. Sometimes I talk about overall inflation, but if you look at core inflation, you exclude food and energy. Currently for 2021, the estimate's about 4.5%. The Fed's own forecast, they're not calling it transitory, but the Fed's own forecast is that it'll come down to the 2.3-2.4 range for this year, and then even further in 2023. So I think, again, putting this all together, the 10-year Treasury yield has gone from 1.3 to 1.8 today in about a month. If you look back December 15th, it was 1.3. Today it's 1.8, and that hurts long duration assets. And it's not the 1.8, because 1.8 is still pretty low. It's the worry that if the Fed has lost control of inflation, and you hear a lot of people talk about that. Next steps, at the December meeting, they basically accelerated the taper. The taper, QE was at $120 billion a month. And again, that's that $8 trillion balance sheet. That just means that they're buying up assets for the balance sheet. They're getting money. They're getting liquidity into the economy. They decided to accelerate that tapering. They were going to taper at $15 billion a month. They doubled it to 30 so they could get it done by March. Second point, the Fed, and this is a James Bullard chart, you can see at the bottom, he's talking about passive balance sheet runoff. This is QT. So as MBS rolls off, as they mature, mortgage-backed securities, instead of buying new ones, they will just let them mature so they don't replace them. And that's a passive balance sheet runoff of basically getting rid of some of the balance sheet assets they have. And he didn't put a number on it. Like, he's not saying, well, we're going to do 30 billion a month, 15 billion. He's not putting any number, but he is saying we're actively discussing it. In his view, and this was important this week, and it's what freaked people out after the minutes came out, is that's something that normally during a tightening period doesn't happen right away. Normally, as Mary Daley said, they wait until interest rates normalize before they start QT, because they want to see if the interest rates going from 0 to 1 or 2 work. I think Bullard, being a hawk, is being much more aggressive. But there's no decision made, and the Fed's going to be data dependent. The Fed's going to look at the data as it comes out in January, February, and March before making a decision. Third point, the policy rate, that's the federal funds rate. That's the over rate. Right now it's 0. The thought that the Fed has is 3 rate increases 2022, 3 rate increases 2023, and a terminal rate somewhere between 2 and 2.5%. And the last point is important, that they could increase or decrease based on the data. And we don't know how long Omicron is going to persist. And one of the points I made this morning is that, the January employment numbers are going to be even worse because Omicron will be, have caused even more damage. But then again, if Omicron is then over, because you can look at what happened in South Africa, people will look past a weak January number. I think that's what the market's doing today. And that's why the market seems to not know what to do, where first it was up, then it was down, now it's down. I think people are saying even if January is light, people will look past it once COVID is, back under control and we're on the other side of the peak. Okay. Slide 7. It's not just the U.S. Euro area inflation also came out this morning, and contrary to what I guess the expectation was, people thought it was going to fall. They look at things year over year. People thought it was going to fall back to 4.8, came in at 5, and core came in at 2.6. People thought that would fall back. It didn't happen. So the ECB's been more dovish. I think you could describe. They've not really talked about rate increases. Christine Lagarde, who's the ECB chair, ECB president, she has said, let's wait. We think inflation is more transitory. This will probably cause the ECB to move more quickly and follow what we're doing here in the US. Okay, so slide 8, why is this important? It's important because, and I've tried to say this in my tweets, but it's hard to capture it. When interest rates go up, short-term rates go up, it's going to feed into long-term rates. And again, this whole relationship between the terminal short-term rate and the 10-year Treasury bond is interesting to look at. This shows the spread between equities and 10-year Treasuries. So you can look at the S&P 500 and look at the PE. The PE on 22 earnings, S&P, you could do this yourself. S&P earnings will be about $240 this year if you look at consensus. Take current S&P, about 4670 or so. Divide that by 240, you get it's about a 19.6, 19.7 PE for 2022. That's a 5.1% earnings yield. Just flip it over, E over P ratio. Take that and compare it to the 10-year Treasury. 10-year Treasury right now is 1.8. Okay, because it keeps going up. So that's a 3.3 spread. When empirical research put this chart together, which was middle of December, the spread was 3.7. So if you take a 5.1 earnings yield and a 1.8 10-year Treasury, sorry, that's a 3.3% spread. So that number, if you look at that curve, that's dropped even lower. If you look at the average since 1977, the average is about 2.5%. So equities are still cheap based on where we are today. But if that spread got down to about 2.5%, people would start worrying about equities in general. And that's an important point, because when I talk about why I still think the stock market's going to go up, it's this chart that I think about, because the spread between equities and 10-year Treasuries, which is the so-called risk-free rate, is still 3.3%. And that's, people hear the term TINA, there is no alternative. What are they going to do? Are they going to put their money in bonds? It's kind of hard to see that. Okay. And then the last chart, and then I'm going to talk more about Tesla. This is an empirical chart that goes back 70 years to 1952. And it's a plot showing 10-year Treasury yields versus trailing P ratios. And it's a very clear negative relationship. The more interest rates go up, the more PEs go down. That's just a mathematical equation, because you're discounting cash flows at a higher and higher rate. Now, what's very interesting is that kink. We call this a kink curve. Kind of at 3%, you see it kind of like drops. And that's because at very low levels of interest rate, you have recessions. And so if you could exclude the recessions, this would be a more straight line down. But in recessions, PEs actually go down because earnings go down as well. And people worry that the recession is going to drag on. So we're kind of in that spot. And so I still believe that as interest rates go up, people worry about interest rates going up even further, and PEs will go down. And long duration assets like Tesla go down more. Anything with cash flows where most of the value is out, 3, 4, 5 years. And so you think of a Tesla, they make money. So I wouldn't call them long duration. I kind of call them medium duration. They have a PE on 23, using my numbers, about 54 times. That's not long duration. Long duration are names like Roku, TDoc, Shopify. Those are names that really don't show much earnings until many, many years out. And those are going to get hurt the worst as interest rates rise. And it's why you see things like, ARK and Kathy, and, I have great respect for ARK. They're getting hurt disproportionately right now because they have a lot of long duration names in their portfolio. Okay. So let's talk about Tesla with that backdrop. So let me just get my charts together here. Okay. So fourth quarter, we think will be January 26th. Elon will talk about the product roadmap. With the volumes, the fourth quarter volumes came in at 308.6. The street was at 265. So a huge, huge monster beat in terms of volumes. Again, I look back over the last 2 years, so 8 quarters, there was never a beat that much by surprise. You don't see beats that big with mega cap type names. And so when you try to figure out what is that worth, 308 versus 265, that's about a 43,000 beat. And you could, again, do the math, multiply that times the 50,000 or so average selling price, 29% gross margin, 1 minus 15% tax rate, divided by the number of shares. It's about 40 cents a share that the street should be raising their numbers by. So the street was at $1.97. Today they're at 218. My numbers for the fourth quarter, by the way, are 255. So right now we got 255, my numbers, versus 218 the street. Is that something to get excited about? Probably not, because a lot of analysts will hold back. They'll hold back for many reasons, but in this case, it's not very few. Less than half have buys on Tesla. Most of them have holds and sells. And so a lot of them will just hold back until earnings come out and then just change their models, update their models based on where EPS comes in. And I looked at Bloomberg this morning. Only about half of the analysts have actually updated their numbers since the big delivery beat on Monday. Okay, so half of them haven't even changed their numbers. So I'm at 255. The street's at 218. And this is where you get into discussion about what is the whisper number. The whisper number is the buy side. So the sell side is the street. They post numbers. The buy side are people like Fidelity, Capital, ARC, ourselves. We update our models instantly. We don't have to post them anywhere. So in order for the stock to go higher on the 26th, if that's when earnings will be, they probably have to beat that number. Okay. The bigger number is going to be 2022, because once, fourth quarter, I think is kind of baked in. Everybody knows it's going to be a decent sized number. One other data point I'll give you, if you look at, go back 8 quarters, go back 2 years and figure out what is the average increase between the day after volumes come out. Okay. So in this case, it'd be after the big move on volumes to the day before earnings. That number going back the last 7 quarters, because you can't include fourth quarter because it hasn't happened yet. That number is about 19%. And so far, I think we've got about, based on where Tesla is right now, we're down about 10%. If I measured maybe 12% since the day after the volumes came out. I think the most important part of the conference call will probably be Elon, and he hasn't really given a roadmap in a long time. And as long as he doesn't get sidetracked and start talking, like he's teaching a college physics lecture, which sometimes he does, I'm hoping we hear about Berlin and Austin if they're not already open. I'm hoping we hear about Cybertruck, which again I think will be late 2022. The semi got everybody's attention this morning because it came out that Pepsi expects delivery, and we heard this last month, but it looks like it's actually happening. They expect to get 15 semis, pre-production trucks for testing in California at the Modesto plant. It's a Frito-Lay plant with 4680 cells, which is also very exciting, before the end of the month. And I think that'll be interesting. But I don't expect the semi to actually get out this year because they just don't have enough 4680 cells. And then the compact's interesting. I don't even know what the compact look like. If anybody's ever seen a smart car, like you go to Europe, you see the smart compact EVs. It's probably going to look like that because you don't want to cannibalize the Model 3. You want something, if you're going to price it at 25,000 euro, which is the number that we've heard about in the past, it really should be a lot less car than a Model 3 to avoid cannibalization. The nice thing about Cybertruck is you really don't cannibalize anything, right? People want pickup trucks. They're not going to not buy a Model 3 or Model Y if they buy a Cybertruck. Okay, so those are the catalysts. It's Berlin and Austin. It's Cybertruck. It's compact. It's the 4680 cells being put into place, because they reduce cost. And people say, well, what about FSD? And I can talk more about FSD if people want me to, but while Elon has promised level 4 FSD, and I know the beta test, 10.8 is pretty good. I still don't think we're at level 4 yet. So I can't get excited about that as much as everybody else to treat it as something that's going to drive value. Okay. So let's go, in the interest of time, and I'm going to back up if I have to slide 12. And then again, going forward, I don't really make some heroic assumptions. I think the biggest change I have, or the biggest delta I have versus the street, is that EV adoption. Thinking about the world as EV adoption times EV share, but it is the way the buy side thinks about it. And you can talk both languages. We can talk about overall share if you want, but it's the way the street models it. So I want to talk the language of the street to understand how they're thinking. And it's also the way most institutional investors, most buy side investors think about it. So don't get too caught up in this. But if you look at these numbers, EV adoption for 2021, and so the bears will argue, well, that's crazy. Look at all the competition that's coming. We've been looking for the competition for 5 years. And I would argue back, but look at the TAM expansion you get by bringing Model Y to Europe. That's new, and you'll be able to bring the price down because you're manufacturing in Europe. You don't have to pay an import tax. You don't have to pay for shipping. And so I think if Tesla can hold its share, that's the exact same model you saw with iPhone. iPhone got a lot of adoption with its smartphone. It didn't really gain that much share, but overall, it got incredible volume growth. Okay. And I don't like to do this, but I just want to show this as a proof statement. Go back to slide 10. And so we track, actually, this is EV volumes, which if you haven't heard of them, they're in Sweden, they're very good. Talk to my friend Victor there if you want to pay for their services. But if you look at 2020 and they track it by quarter, and they actually sell a lot of their data to the OEMs. And so, in fact, Tesla is actually one of their clients. And so their data is pretty accurate. And they were pretty close, by the way, on their full year volumes. I think they had a target of 920 or something. They came in at 936. But anyway, if you look at that solid black line, for 2020, EV adoption was about 4.5% to 5%. And it's ending this year at 11.4%. And it's being driven by China. China, because you've got so much EV demand and so much EV supply, that number's gone through the roof. Europe has gone through the roof. You can see the US is still about 4%. And if you get the Build Back Better plan, which I didn't talk about, but I do think that will come back in a smaller form, that number should really rise. And let me just talk a little bit about Build Back Better because it is an important catalyst, even though people say, well, they're selling every car they can make. Why do you care? I care because 3 to 4 years from now, it's going to matter. And you've heard in the last couple of days, if you're following the Washington, discussions, Manchin has basically, he's called the union credit, the extra 4,500, convoluted, un-American, other things. And Stabenow, who's from Michigan, and Wyden, who were the ones who first proposed the EV credit, have backed off a little bit and said, look, we're willing to compromise. So I think once this comes back, and it'll probably come back in March, it has to come back because it's midterm elections. Biden wants to get the Dems to have, at least 50 people in the Senate. And, he's only got about 5 or 6 extra positions in the House. They will want to take credit for something. This will come back in some form, but it'll come back much smaller. I think if he comes back with an 8,000 EV credit, that's something that Tesla doesn't have. But I don't think it's going to come back till about March or April. Okay. And and this is an important point, if you look at slide 11, and this is EV volumes forecast, they're looking for 2021 to wind up at 7.4% in EV adoption. And again, go back to my chart on slide 12. I'm using 6, and I'm using 10.5 for all of 22. We could say we led. I don't know because the stock went down, but the reality is all growth stocks are getting trashed here, as you know. We raised our 22, and what is driving this? It's 2 things. It's the capacity additions. So it's Austin and Berlin and any other plants, and we're going to have to see more capacity added. China expansion. We believe UK, India are also on are next. And if we can get that, the trick with price targets, you got to pick a valuation in 2025. And so we use a multiple of 50 times. Right now, as you know, it's over 100 on 22 earnings. If you look at, again, more stable, lower growth companies like Microsoft, Apple, Amazon, they traded about 2.5 times PEG. Let me just give you one perspective on how we're changing the portfolio as a result of all this, or I wouldn't say changing because we're not. We're just, we're trying to manage in such a way that as interest rates go higher, and so, we're classic growth managers, Dave and I. We buy innovation, we buy disruption. You don't really see too many value stocks in our portfolio. But what this type of environment causes us to do, if we like a name, let's say it's a name like a Shopify, we might pass on it for now because we don't know what inflation is going to do, and we want to keep the portfolio relatively moderate duration. So we don't want to change our investment philosophy because Dave and I are both growth managers. We're not good value managers. Our average PE, we were looking at this morning on 23 earnings, is 37 times. S&P is at 20. So we're about twice as growthy as what the S&P is. And that's why our performance has been, I'll call it mediocre. And we've tried to shift, again, shift's the wrong word, but try to favor names in our portfolio that are a little bit shorter duration. So that's, we got a lot of grief for owning HOG, Harley Davidson, as they go, they shoot for electric bikes leadership. That's been a good name for us because it's more value-like. We've increased our position in Google. Google's now 9%. Hertz, LPL, Caesar, Nike, PayPal, even CRM. Those are all what I'll call moderate duration. And so again, we're not changing anything we do. We're growth managers. We don't change our stripes. We don't change our investment philosophy. I think that's why we're only down 9%. And I use only in quotes. Last thing I'd say is if you think we've added some value, remember our ticker is FFND. We think our fund is pretty cheap right now. Okay. With that, let's open it up for questions on this great day.
All right.
Where's Tesla trading?
Around that level, 10-3 level or so. So we have a couple of questions. Not surprisingly, most of them are about the stock price versus the fundamentals, because you kind of laid it out pretty well, and also what's going on with rates. But as we've seen for a while now, the street continues to be pretty negative on Tesla. You've got almost 50 people covering Tesla, and only 21 of them are buys. You've been on the street on the buy side and the sell side. And there's a lot of interest in why is it? Why is such controversy around Tesla? Yeah. Because they have really, quite frankly, delivered versus any other large cap stock, whether it's semiconductors or on production and everything. So chat about that a little bit, and what is going to change, or what could change going forward to get people more bullish on the sell side.
Okay, it's a great question. One is valuation. Second, I think is just, and I don't want to sound negative because I'm not. It's our largest position. But I think there's a distrust of Elon, and I can't put my finger on what it is. It's not really, that he was smoking marijuana on Joe Rogan. Most PMs don't care about that. But I think there's no strong number two. So there's key man risk, and that's not true of the other big mega caps. I think the Bitcoin purchase, I know people don't want to hear me talk about it, but it's not normal. You don't see big cap companies take corporate cash and invest in something as well called risky as Bitcoin, because people could do that themselves. So that's another factor. I think if we point a strong number two with operating experience or great marketing experience, I think people would feel more comfortable. I think the way he sold stock in November, December is definitely different than what you've seen in other companies, where they would have just called up Goldman and Morgan Stanley, got it done in a couple of days, but for whatever reason you dragged it out for 2 months, and I think people are still perplexed about that. On the other hand, I look at this guy's brilliant. He's executed. He's single-handedly led the whole automobile industry into EVs, and he's delivered. And so I love the stock. It's my favorite position, in spite of the fact that there's no strong number two. And if Elon would do some of these more conventional things, which I know he doesn't want to do, I think you'd get a lot more institutional ownership. I think that not having a strong number two is a big deal in talking to people, because that is not true, again, of the other mega caps.
Okay. Let's try to focus a little more on Tesla fundamentals. And competition has been obviously a big issue over the years, and it's kind of fading in some of the areas. But in one area that continues to come up is in trucks. F-150, Cybertruck. Looks like Ford's going to be, and GM are going to be ahead of the Cybertruck. So talk a little bit about that. Should we worry about it? What do you think about Cybertruck? And what do you think about some of the offerings that are out there from some of the competitors?
Yeah. Well, people have talked about competition forever, and they talked about it when we just had Model S and they brought out Model 3. I remember when Model Y got launched, the bears were convinced it would just be 100% cannibalization of Model 3. And the thing that's nice about Cybertruck is there will be no cannibalization. It's a totally different animal than an SUV. It's a very different animal than Model 3 or Model Y, which is 90% of the volume. And these are the highest margin vehicles in the automotive business. And so I do think, because it's a very shockingly different vehicle, because it's got the Tesla brand on it, it'll sell like a hotcake, and people will probably be able to buy them and then flip them 6 months later, because the price is going to start right now. The list price is $39, and I think it's going to be a huge profit contributor to Tesla from day one. And then let me just talk about competition, because my professional career has been, I don't say all over the place, but I've done a lot of different things. I actually started as a brand manager. People don't know this, at Johnson & Johnson on the Tylenol business. So I think I know a fair bit about marketing effectiveness, how to calculate ROI on marketing, and a lot about competition. Competition is doing what Nokia, Motorola, BlackBerry tried to do when Apple came out. They're just copying. They're doing exactly what Tesla's doing. And what they use the term brand taint. I listened to Mary Barra talk the other day. She didn't mention brand taint once to even overcome it. And I think they're fooling themselves. because when you take a Silverado brand or a Cadillac brand or even a Hummer brand and you slap it onto an EV, the consumer shakes their head and say, I don't get that. You know, this is a gas guzzler. And how do you suddenly expect me to believe that it's really good at making EVs? Where Tesla is 100% EVs, Rivian's 100% EVs, Lucid's 100% EVs. But you take these brand names that are gas guzzlers and slap them on, you know, and say, okay, we're now going to be an EV player. The consumer doesn't believe you. And that's why I think GM only delivered 26. I mean, they're going to say that they only delivered 26 because they have, you know, supply constraints. But I really think even if they didn't have supply constraints, you would not see them deliver maybe because of brand taint. And the fact that Mary Barra, who's not an engineer, she's not a marketing person either, she's an administrative person, didn't even address it, struck me as really odd, because to me, the number one reason that you're not going to get that much competition from these guys, and I call it kabuki theater, is because of the brand taint issue.
Okay, good. We're running up against 45 minutes. So, Gary, do you have any closing comments for us?
No, I think we feel really confident about Tesla. We feel better about its, you know, the catalysts that are in front of us than we've ever felt. It's our number one position, and I feel really good about, you know, where they are today versus, you know, even where they were a year ago. So it'll remain our largest position. Okay, biggest risk is macro.
All right.
Thanks, everybody.
All right.